Hi, everyone. As you are filtering in here, I will go ahead and do a couple quick introductions. We'll go over some housekeeping items, and then we will go ahead and get started. So today's webinar is a remote seller sales tax update. This is a 90-minute webinar. It is worth 1.5 CPE credits. And if you are here for the CPE credits, there are a couple of things you have to do in order to receive that CPE credit. So we will need you to answers the polls as they come up on your screen. If you have any issues with those polls, just send me a message. I'll help you get it sorted out. You also will need to fill out the survey at the end of this webinar. And again, you have to do both of these things in order to receive that CPE credit. The survey will pop up for you automatically as you are exiting, and it will also be emailed to you in 24 hours. So give us a couple business days to get you that CPE credit. And then please do those things if you want it. And a couple more important housekeeping items. If you have questions as we are going along, please reach out and ask those questions at any time. If you wiggle your mouse around, you'll see the Q&A button. You can use that Q&A button to submit your questions, and we are going to do our absolute best to address them at the end of this webinar or follow up with you via email. Again, use that Q&A button, send your questions at any time, and we will get to them at the end. And we also will be linking today's slides in the chat feature once we get the ball rolling here a little bit. They're also uploaded to Zoom and will be emailed to you in 24 hours as well. So there's a few ways to get your hands on those slides. And our pre-recorded webinars. So we do offer these webinars in a pre-recorded version that still offers CPE credit. You can purchase those one-off. You can purchase a membership to our Salt Vault, which will get you access to some of these things, all of these things listed here, plus more. So if you have questions about that, please reach out and ask. That is called our Salt Vault and is a really great resource if you're trying to tackle some of the sales tax world on your own. So let's do some introductions. First and foremost, for Sales Tax and More. Sales Tax and More is a full-service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We would love to hear from you, and we would love to work with you as well. And a couple other important things here, or actually, I guess, an introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well-known for his work in the e-commerce industry, which was what brings us to our webinar here today, Remote Seller Sales Tax Update. Mike, you can take it from here.
All right. Thank you very much, Ellie. Welcome, everyone. Thanks for joining us today. And thanks to Ellie for that great introduction. We've got a lot of information to cover. Let's go over some of that. We're going to start with a brief definition of nexus. We're going to go over some court cases. We're going to talk about economic nexus and some current trends that are happening. Then we're going to talk about physical nexus. And people, sometimes say, well, Mike, why are we going to talk about physical nexus? This is about remote sellers. And the reason we're going to talk about physical nexus is because remote sellers often have not only an economic nexus, but a physical nexus. And sometimes they don't realize that they do so. So we're going to touch on that. We're going to talk about marketplace collection. We're going to talk about deregistrations. We're going to lightly touch on income tax, what the future holds, in my opinion, and then how to register and some registration myths. Before we get started, though, let's do the first poll question, Ellie.
That question should be up on everyone's screen right now. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. We just want to get a feel for your Nexus knowledge levels. So how would you rate your Nexus knowledge? Your choices are what's Nexus, you know the basics, you have an intermediary knowledge, and you are a Nexus expert, or like we like to say, an expert. Mike, I'll leave this open for a little bit longer, but we have a really good mix in the crowd today.
Yeah, a couple of experts. Great. my camera stopped working on my computer, so I got a fancy, external camera, and I ended up dropping it and breaking it. So you don't get to see my lovely face today, so I apologize for that. All right, so the worst time to find out that you have problems or that your clients have problems is when you're being contacted by state. Maybe you're getting a Nexus questionnaire, maybe it's a telephone call, maybe it's an email, a piece of snail mail. But the reason why that's the worst time is because there are a number of programs out there that you can use to mitigate any past exposure if you're being proactive. Once the state contacts you, in a lot of instances, there are always exceptions to every rule, like Michigan and Florida. But one of the best tools out there to mitigate past exposure is a voluntary disclosure agreement. And that's generally going to be off the table if the state contacts you. And states keep good records. I mean, you may think that the state doesn't remember that they called you 2 years ago. Um, Unfortunately, they do. And a lot of voluntary disclosures are done on an anonymous basis. You enter into them, and all of a sudden you disclose who the client is, and they say, "Oh, you're not eligible for this. We contacted you 2 years ago." We've had clients who tell us, sometimes knowingly tell us, that they've never been contacted, and then it's a problem when we disclose who they are. And some of them just don't remember, but the state does keep good records of these things. So if you do remember being contacted, let whoever you're working with know, because it could be a problem for you. The moral of this story is you got to be proactive before the state reaches out to you. You want to make sure that you got all your ducks in a row, or that your client has all their ducks in a row, because you want to be able to take advantage of these mitigation programs wherever you can. All right, so let's talk about quick definition of nexus. And nexus is just a fancy word that means link or connection. Now, when we're talking about taxes, it's the link or connection that must be present with the state before that state can require you to do anything, like collect its taxes, like a sales tax or a seller's use tax, or pay its taxes, like an income tax, a franchise tax, or a consumer use tax. And I'm sorry, my phone was just dinging here and I had to turn it off there. So this is what we call Nexus. It's just a link or connection with the state. Now, when we're talking about nexus for sales and use tax, there are two primary types of nexus. You have your physical nexus, often referred to as traditional nexus. There are different types of physical nexus. Some of these are obvious, some are not so obvious, some are common, and some are less so. When it comes to the economic nexus, which is the second primary type of nexus, the thresholds are based on revenue and or transactions. Different thresholds and the different effective dates, what's included in those thresholds, it's different for each state. So states never make anything easy.
Hey,
Now we
Mike,
say, yeah,
it looks like your slides aren't changing. Um, do you want to, it looks like your slides aren't changing on this on the shared screen. So we're still back. And sorry, I should have popped in here sooner. But we're still back at the intro slides.
okay.
Okay, there we go.
All right, that was different. Okay, so we say it all starts with Nexus because if you don't have this link or connection with the state, then the state can't require you to do anything. So if you don't have this link or connection we call Nexus, you've got no problems and no responsibility. Ellie, why don't we go to the next poll question? We're going to start talking about some court cases after this.
That should be, so that poll question should be up right now. We want to know, choose the best definition of nexus here. And quick reminder, you do have to answer these polls in order to receive CPE. I'll leave this open for about a minute here while Mike moves forward and then I'll close it out. But Mike, most people are getting this one completely right.
Absolutely. Okay, so let's go on. The screen's changing still?
Yes, we're at let's go to court.
Great. All right, so all of these cases are U.S. Supreme Court cases. And this first one I think is really important, especially nowadays. This was National Geographic versus the Board of Equalization. Board of Equalization was California. And the takeaway from this is that the taxable activity does not have to relate to the nexus creating activity. Another way to say that is once an entity has nexus, all of the entities, no matter what all the entity, no matter what the business channel has nexus. And the reason why I say this is becoming a bigger issue is since the pandemic, a lot of companies who may have been selling on our uh, on a wholesale basis, or they were acting as distributors. They started selling directly to the consumer because they didn't want to be in the position they were during the pandemic, when the only companies that were doing well really were those that were selling online, those going directly to the consumer. And they're saying, well, when I start selling, I know in like states like Texas and California, the thresholds are $500,000. So I'm just starting out selling to the consumer. So it's going to take me a while to build up that retail business. They've never worried about sales tax before, with their wholesale business, because they didn't have to collect tax on most of the transactions. However, according to this, the wholesale business, you may have a nationwide network of reps. That's the nexus creating activity. The taxable activity may be brand new, the selling directly to the consumer, but it's taxable from day number one. So a lot of these companies were thinking they had a while to get to that 500,000. State doesn't look at it that way. You need it to be collecting from dollar number one because the entity itself already had nexus, even though it didn't have any taxable sales. So much more important nowadays than it has been in the past. Complete auto transit, very important when we're talking to remote sellers, because a lot of remote sellers truly believe that, only Congress can, regulate interstate commerce and that the states don't have the right to tax interstate commerce. Well, even the states didn't think they had the right if we go back to the 1930s when the modern day sales taxes were introduced. But that started changing in the 50s. And in 1977, we have complete auto transit, and the US Supreme Court, they didn't come out with anything new. They just cobbled together all of these things that had been coming up since the 1950s. And they said, yes, a state can tax interstate commerce directly so long as it meets a four-prong test. And these are the four prongs, and these are pretty easy prongs to meet. We're going to talk about a state that keeps tripping over their own feet and can't get it right. Um, is it fairly apportioned? Internal consistency. If every state imposed the same rule, would there be double taxation? Now, it doesn't say if there's double taxation, which a lot of people tell me, well, Mike, that's double taxation. It's not allowed. Well, this doesn't say that. If every state had the same rules and there was double taxation, then it would be unconstitutional. Unfortunately, most of the states have their own rules, so they don't all have the same rules. So this is one that we end up with double taxation in a number of situations. Now, the one that is we're going to talk about in a little bit more detail is number three. Is it discriminatory? And we're going to talk about Illinois, who can't seem to stay out of their own way in a little bit down the road here. Uh, these two cases, when we're talking about physical presence, these two cases have to be, in my opinion, the most important. And Scripto is a 1960 case. Scripto was a pen company. They were located in Georgia. They had 10 independent sales reps working, representing them in the state of Florida. The state of Florida said, hey, we think this creates enough of a significant presence that it's going to create a significant nexus, and therefore you should be collecting and remitting our taxes. And Scripto said, "You're out of your mind. I mean, these people don't work for us. They're true arm's length transactions. I mean, we don't control their hours. We don't control their activities. So we don't think that they should be creating Nexus for us at all." Well, it goes to the Supreme Court. Unfortunately, the Supreme Court sides with the state. And then they say the difference between an employee and an independent contractor is without constitutional significance. In other words, there's no difference between the two. So this is what we see the beginning of what many call attributional nexus or agency nexus. I try to keep it simple. I just call it third party nexus. Third parties can actually create this like a connection for you. And we see this revisited in 1987, so 27 years after Scripto. Tyler Pipe, it's a Texas company. The state of Washington says, hey, Tyler Pipe, according to Scripto, um, you've got this independent contractor up here in the state of Washington, and we think that that's enough that you should be paying our business and occupation tax. And Tyler Pipe said, "Oh no, this is not like Scripto at all. This person doesn't represent us exclusively. They represent multiple parties, and they're not very good at their job. They don't send us very much business at all. It's like having less than a part-time person. So." Um, Unfortunately, this goes to the Supreme Court again, and the Supreme Court again comes down on the side of the states. And they said that, and I'm going to paraphrase in the beginning here, it doesn't matter what you call someone, doesn't matter how you pay them, doesn't matter if they represent you exclusively or if they represent multiple parties, doesn't matter if they do this on a full-time or part-time basis. And here's the important part. If they're helping you to establish or maintain a market, then that can create nexus. And this is such important language, establish or maintain a market, because the states took that language and ran with it. Some of them incorporated directly into their statutes, their rules, their regulations. The state courts use it. What better case for precedent than a U.S. Supreme Court case? So this is very, very, very important. And it's something that is common. Pretty much all states say that third parties can create nexus, um, but it's not very obvious because if I'm thinking about what will create a link or connection for me that we call nexus, I don't often think of third parties. What are they doing? So in all the years I've been doing this, the biggest problem out there has been this third party nexus. I see more companies with bigger assessments related to this than anything else. All right. We're going to touch on that in a little bit more detail later on. Right now, let's get to Wayfair. Wayfair is the 2018 case that overturned the two previous cases that talked about physical presence. It was Quill and it was National Bellis Hess. And when the U.S. Supreme Court, they didn't say times have changed, so we need to, change our thinking on this physical presence. They said, and in 2018, it was fairly rare for the Supreme Court to say, we made a mistake. They said we made a mistake because we never should have introduced the concept of physical presence to begin with. We inadvertently created a protective class, and that was never our intention. So we never should have introduced this concept. So when they overturned these cases, in theory, it's like these cases never happened. So the states could have went back all the way to the 1967, this National Bellis Hess case. which is when they started talking about physical presence. And um, what made the Supreme Court a little bit comfortable, South Dakota said they were only going to do this on a prospective basis. In other words, going forward. And that gave the U.S. Supreme Court enough cover to allow South Dakota to move forward with this economic nexus. And an economic nexus just means that this link or connection with the state can be based on sales or transactions or a combination of the two. No physical component is required anymore. Now, South Dakota thought $100,000 or 200 transactions was fair. The U.S. Supreme Court didn't explicitly agree to that. They sort of gave a wink and a nod, but they sent it to the lower court and said, you guys can hash this out. Unfortunately, the case was settled before that got hashed out. So it's still out there. We have seen states moving away from this. Even South Dakota has gotten rid of their 200 transactions. Now, as soon as I say that, people say, oh, we don't have to worry about transactions anymore. That's not what I said. There's a trend away from it. And unfortunately, some very aggressive states still have it. About 35% of the states right now still have this 200 transaction threshold. States, again, don't make anything easy ever. So what's included in those thresholds will differ widely from state by state. I'll show you a chart in a minute here we're going to give out. Two important things when we're talking about nexus, economic nexus. Number one, it doesn't override any other type of nexus. And if any of you have heard me talking before, I say this all the time, a couple times a month. I get a call from someone and they'll say, hey, Mike, I want to deregister in the state of Texas, or Mike, I want to deregister in the state of California. And if they're an existing client, I'll say, well, okay, how come? Well, we're underneath $500,000 in the state, and they don't have any transaction thresholds. And at that point, I'll ask them, okay, well, in California, the last time we spoke, you had inventory in an Amazon warehouse. Oh, yeah, I still have that, but we're underneath $500,000. Or the state of Texas, I may ask the question of, well, last time we spoke, you had an independent contractor traveling into the state. Oh, yeah, we still have that. Well, at that point, I have to break it to these clients that um, it doesn't protect you from any other type of nexus. As a matter of fact, a physical presence, when it comes to sales tax, not so much all taxes, but sales tax in particular, a physical presence is going to trump, it's going to override any other type of nexus. So this is not a way um, to get protected being underneath those thresholds. It's just one more way for the state to get you to do what they want you to do, which is collect or pay their taxes. So very, very important there. It's not a protection. It's just another option for the state. Number two, my salespeople come to me every week. Mike, I talked to another accountant. He said that he don't have any clients that are subject to this internet tax. Well, tax and nexus, two entirely different concepts. That's number one. But this is not an internet issue. This is a multi-state issue. I mean, you don't even have to have a website to be subject to economic nexus. I mean, you can be selling entirely by telephone, entirely by referral. You could be selling by infomercial. You can be selling by catalog. It literally doesn't matter how you sell. If you are selling into multiple states, or if your clients are selling into multiple states, this is potentially an issue for you. So those are two important points there. And here we are, coming up on 7 years, and these are still questions and issues that are coming up on a daily basis. All right, so here's the chart I was telling about, and we update this chart every time something changes. A lot of useful information on this chart. Right in the middle of the page here, it's going to tell you what the state says to include or exclude from the remote seller's threshold calculation. So some states include sales through a marketplace. like an Amazon or an eBay. Some states exclude that. Some states include sales for resale. Some states exclude it. Some states include exempt sales other than resale, and some states include it. So, again, the states don't make it easy. Now, the problem out there is that a lot of software companies and a lot of even platforms like Shopify, they'll tell you, oh, you don't have to worry about Nexus. We'll handle it all for you. But they just aren't granular enough. Either it's a limitation of the software itself, or they don't gather enough information to give you an accurate reading. If you're relying on a site just like Shopify, invariably, you're getting registered in too many states. I mean, I have people come to me a couple times a month say, Mike, I need to get registered in 20 states. And I say, how come? Well, because Shopify is telling me to do so. Well, if you're not looking at a chart like this, we have a service. It's called a data review for $795. We'll go through all the information on this chart and your specific facts and see if you need to be registered or not. And I'll come back and say, hey, based upon your specific fact pattern and what the states are looking for, even though your gross sales may be over the thresholds, the way that the state measures, the thresholds may be different, and you only need to get registered in 4 states or 5 states or 7 states. But it's generally going to be a lot less than if you're just looking at what Shopify tells you. Now, every once in a while, um, you won't be getting registered in enough states. As a matter of fact, we had a client who's been with us for a couple of years now. This software company, and for those of you who have heard me before, I am not a big fan of software companies doing services. Software is software. They're very good at software. They are horrible at services. And here's another great example of why. Uh, they told this gentleman, you can get deregistered in all these states because you're underneath the economic threshold. Um, what they didn't tell him is that, well, your sales are material in these states, and you have inventory in all these Amazon warehouses, and most states still look at inventory in an Amazon warehouse as Nexus creating. So software company told them, hey, it must be true. So they left us because they wanted to file in less states. Well, that's going to be a big problem because a lot of states still include inventory in an Amazon warehouse. So, sometimes you're not getting registered in enough states. When a software company or when some type of service is telling you based upon your sales, invariably they don't have enough information. A lot of people don't run their Amazon sales through Shopify. I mean, Amazon's paying the sales tax. Why would I run it through Shopify or Avalara or wherever else? So there's just not enough information there to make the correct determination. So these services provide red flags. In other words, they let you know you need to be paying attention to this stuff. But then you need to pull out a chart like this or give someone like us a call and go through it yourself to see if your fact pattern actually matches what the state is looking for. So some other great information on here if you're trying to figure out what your past exposure may be. It's the effective date. It is the actual transactions, if there was a transaction threshold, what date it went away. It talks about what type of tax you should be registered for. In some states, it's not easy to figure it out. Should I be selling, like in the state of Oklahoma, should I be getting registered for the vendor's use tax, or should I be getting registered for the sales tax? Well, if you get registered for the sales tax right away, you got to pay $25 in order to get a sales tax license, but you also have to get registered with the Secretary of State, which costs $350, and you got to get a registered agent. Then you're subject to income tax on a yearly basis, and you got to renew everything on an annual basis. That's a lot of work. if you get registered for the seller's use tax, which is what a remote seller should be doing, none of that. You don't even have to pay the $25 to the state. It's a free registration. So, and you got to be careful too. Again, software companies. I'm a big believer in you shouldn't be using software companies to perform services. Uh, TaxJar could not file use tax returns for some reason. They could only file sales tax returns. So they told all of their customers to just switch over. There's no difference. Just go and get the sales tax. Well, a lot of these customers a year or two later are finding out that, yeah, there is a big difference between a, a vendor's use tax license in Oklahoma and a sales tax license. But hey, that salesperson got their commission and TaxJar got their client, and who cares? Which is what the opinion of a lot of these software companies is, unfortunately. But anyway, that's why this is a great tool. Um, is registration required if all of your sales are marketplace sales? And what the time period? What type of leeway do you have? Some states, your next sale needs to be tax collected on. Some say within 30 days, some states say within 60 days. So there are some states who are a lot more, um, give you a lot more latitude than others. So very, very important tool here. This is something that Ellie is going to hand out to you, and it's always available on the free portion of our website. All right, so we said that South Dakota said that they were going to do this prospectively. In other words, on a going forward only basis. But that was um, prospectively from the effective date. And these effective dates were coming up on 7 years this June. So 7 years. When this started, nobody had any uh, past liability whatsoever. Now you could have 7 years of past liability. These effective dates are getting old, and some states are questioning registrations. Other states are letting you get registered and then coming back and auditing you. A lot of companies just want to, register going forward. They said, I didn't know that we were required to be registered, so I don't want to take care of the back taxes. And in a lot of states, you can get away with that. Some states, like these ones here, Arizona, Arkansas, Illinois, Wisconsin, and Maine, cannot do it. They're auditing pretty much everybody. Maybe not right away, but they, after, 6 months or a year or 2 years or 3 years, they're registering you. We had one client that used a January 1st of 2019 start date, and Illinois went after him because they should have been registered in October of 2018. They went after him for 3 months. So it can get pretty petty out there. So you want to act now before the state finds you. You don't want to procrastinate. And in quite a number of states, you do not want to try to do a prospective registration. All right, so we talked about there was a trend away from transactions. So the list of states up top, these are the states that have done away with their transaction thresholds. The second group of states are the states that have never had any transaction thresholds. And then Connecticut and New York are a little bit different. In the states that do have transaction thresholds, they use the word or. So it's $100,000 or 200 transactions. Connecticut and New York use the word and. So in Connecticut, it's $100,000 and 200 transactions. In New York, it's $500,000 and 100 transactions. So they're a little bit different from the rest of the states. When we say after the fact, that means that these are states that have changed some of their remote seller guidelines after their initial. So most of these are about the states dropping the transaction thresholds or dropping the monetary thresholds. Arizona, when they started out, they were at 200,000, and they went to 150,000, and then they went to 100,000. Tennessee started out at 500,000, but they dropped to 100,000. So sometimes when it comes to monetary thresholds, you may have never crossed 200,000 in Arizona. You're thinking you're safe, um, but it's at 100,000 and you may be over 100,000. So this is not something you can do once and forget about it. I mean, you should be checking every year to see if you are over the thresholds or if the thresholds have changed. Sometimes you can deregister. If a state drops the transaction threshold, sometimes you need to register if they dropped their monetary threshold, or let me change that, lowered their monetary threshold. Alaska, a lot of people still don't realize. They say, well, there's no taxes in Alaska, sales taxes, and at the state level there are not, but at the local level there are. A lot of the boroughs and a lot of the municipalities do have local level taxes, and Alaska formed or all of these local jurisdictions got together, formed the Alaska Municipal League, who administers their program. And if you have $100,000, it used to say $100,000 and or 200 transactions. Now it just says $100,000. If you're over $100,000, then you have an economic nexus in the state of Alaska. All right, so all states that have a sales tax now have an economic nexus. These were the last three holdouts. Um, so none of them had any transactions, but this is a good example of how states look at the lookbacks. Florida, they say $100,000, no transactions, but the look back period is based on the previous calendar year. So you only have to check that once every year. And if you've over the threshold in the preceding 12 months, then in theory, you should be getting registered in January. If you're not over it in the preceding 12 months, then you don't have to check it again to the following January or end of December. Now, Kansas, they became effective in the same day, same rules and everything else, only their look back period is the previous calendar year or the current calendar year. And that's a big distinction there. So if you were not over it in the previous calendar year, and your business is growing at a normal pace, maybe you don't have to worry about it until next year. But if your business is exploding, we had one company that was on Shark Tank, and I was doing a data review for them in the month of April, and they only gave me last year's data. And based on that, they were a small company. They were only registered about 3 or 4 states. I told them to get registered in another state or two. And the salesperson said, Mike, I don't think that's right. They were on Shark Tank. Their business is exploding. I said, okay, give me year-to-date information. And when I looked at the year-to-date information, which only went through March, I changed my recommendations from, just an additional 2 states to almost 20 states. Because that's how quick their business was growing. And you don't want to wait till the end of the year if your business is virtually exploding. When the state says previous calendar year or the current calendar year. If it says just the previous calendar year, like Florida, who cares? Wait a full year for it. But some states like Illinois say rolling 12-month period. So you need to be checking it every quarter in the state of Illinois. So anyway, that's important information there. If your business is exploding, you can't let this go. If you're getting close to something, it's better to go ahead and get registered sooner rather than later because you'll get busy or something will happen. You meant to get registered. All of a sudden, it's the end of the year and you've got 6 or 7 or 8 months worth of exposure. All right, so Pennsylvania was sending notices to those with inventory in Amazon warehouses. Uh, the court ruled against Pennsylvania on the sales tax side, but on income tax, they're still pursuing sellers based on inventory in Amazon warehouses, just not for sales tax. Um, Illinois, the remote sellers must collect destination-based local jurisdiction tax as of 1/1/2021. And that's a problem. And we're going to go into that on the next slide. On 1/1 of 2025, if you have physical nexus in Illinois, you can no longer be registered for the retailer's use tax. They closed one loophole out there, but they didn't address the major problem. Colorado's self-administered local jurisdictions now require collection and remittance. I think this is going to go to the U.S. Supreme Court, but I don't know if they'll uphold it or not. But Colorado, the local jurisdictions are extremely aggressive, so aggressive that we will not file returns for someone unless they get registered through the Colorado's easy program. It's not easy. I say that with air quotes. It's called their SUTS program. We'll treat it as one return when we're filing for our returns clients. But if our clients don't agree to that, we cannot file Colorado for them. It's a nightmare. You get so many pieces of mail from all of these local jurisdictions when they see you're filing at the state level. It's just a total nightmare. All right, so let's get to Illinois and talk about what the problem is there. We said that you had to file the retailer's occupation tax prior to that at destination based. Prior to that, um, if you did not have a location in Illinois, you would register for the retailer's use tax. And the difference between the two is that the retailer's occupation tax is subject to the local taxes, or you have to add the local taxes in Illinois, where the retailer's use tax, you don't have to worry about the local jurisdictions. So the way it was set up is that remote sellers with no physical presence at all had to collect the retailer's occupation tax destination based. If you had a physical location in the state where you were shipping inventory from, then you would sign up for the retailer's occupation tax origin based. And if you had physical presence there, but you were not shipping inventory from it, then you were allowed to sign up for the retailer's use tax. Now they got rid of that loophole. That was something easy. We were telling clients just, hey, go in there and create, if you had economic nexus, just go in and create a physical presence, send a salesperson into the state because it'll be a lot easier on you. And the reason why is there's almost 4,000 local jurisdictions in Illinois. So if you have to collect retailers' occupation destination based, it's a nightmare. We had to file, hire 3 or 4 people just to file the Illinois returns for our clients. Calculating the tax, another nightmare, almost 4,000 different jurisdictions you got to worry about. So the reason why this is a problem is that we believe it discriminates, and we've been saying this for years, against interstate commerce. That's one of the prongs, the 4-prong test. And for some reason, no matter how many times Illinois goes in and tries to correct this, the one thing that is going to get them in trouble with the U.S. Supreme Court, they can't seem to fix. And finally, someone is taking them to court. They said this is unconstitutional. It discriminates against interstate commerce. We've been saying it the whole time, but Illinois very, very aggressive. And they're still being aggressive despite being taken to court over this. So we think that even though Illinois is wrong and that, the way they're enforcing this is unconstitutional, the fix is too easy and they may make the fix retroactive. So we're counseling our clients to go ahead and do this, even though we know the state is wrong. And if you have us to file the returns for you, it's not a real big difference for you. You just got to figure out the rates. But if you're filing on your own, it's a nightmare. So we'll keep you updated on how this case turns out. All right, something else that is a real pain in the neck out there are retail delivery fees. And Colorado started this trend. They imposed six different fees. They totaled 27 cents. The fee was imposed on any transaction with at least one item of taxable, tangible personal property delivered in the state by a motor vehicle. It was retail only. This became effective in July 1st of 2022. Um, it was designed to generate funding for environmental projects and also infrastructure projects. Um, if it was being used specifically for that, okay. There's a lot of infrastructure that needs to be done in the state, but money doesn't always get used for the purpose that it's collected. And it originally applied to all sellers and had to be collected from customers. You could not pay it on your customer's behalf. So, I mean, you could be selling, $30,000 into the state. You were supposed to be collecting this. Well, they fixed some of these issues in the following year. So on July 1st of 2023, it only applied to sellers with sales into the state of Colorado of $500,000 or more. And the sellers could pay. And the reason why that's important is they could not set up their software to be able to collect this correctly. So they said, hey, it's 27 cents. We'll just pay it on behalf of our clients. On July 1st of 2024, went up to 29 cents. We'll see what it's going to increase this year. Generally, every year in July, they increase these fees. And this requires a separate registration and a separate return. So again, it's more of a nuisance than anything else. But if they need money for infrastructure and it's going to help that out, can't fault them for trying to do it. Minnesota retail delivery fees. This one is better in some ways. It's worse in some ways. The fee became effective on July 1st of 2024. It's imposed on any transaction with one item of tangible personal property delivered in the state by a motor vehicle. This one has a $100 minimum invoice requirement, so that helps out a little bit. Again, it's designed to generate funding for infrastructure projects. Um, where this one differs, it applies to sellers with greater than $1 million of sales in Minnesota, so it covers a lot less people. The fee is 50 cents, and the seller has the option to pay it out of their own pocket. What makes this one a little bit worse is there's so many exemptions for it. Do I have to do this or do I not have to do it? Exemptions for food ingredients, prepared foods, drugs and medical devices, baby products, restaurants, sales to exempt entities. So sometimes you get so many exemptions, it's worse than not having any exemptions. Who has to pay this and who doesn't. So, both Colorado and Minnesota, I think, are more headaches right now than anything else for those who are required to do this. Now, not every threshold is economic nexus. So we're going to talk about three of them today: cookie nexus, click-through or affiliate nexus, and notice and reporting requirements. Now, Cookie Nexus, Massachusetts was the only state that was doing this. They got slapped down by the courts a number of times. They still kept enforcing it. They made you take them to court pretty much every time. Now, the effective date on it was 10/1 of 2017. So we're 8 years out from this. I'm not seeing it too much anymore. I haven't seen too many in the last 2 years or so. But every once in a while, this will rear its ugly head. This was prior to uh, their economic nexus. So, economic nexus, they sunset this, but for a period of roughly a year or so, uh, they said that this was in effect. Now, the reason why I still talk about this is Cookie Nexus is when you have the installation of data packets on in-state computers. And when we get to income tax, these data packets, these cookies, that is something that will nullify the protections of Public Law 86272 under the new MTC guidance. So even though Massachusetts is becoming less of an issue, and this is not really an issue for sales tax anymore, for income tax, I think it is going to be an issue going forward. All right, so we have click-through or affiliate nexus, and this started the state of New York. They said, hey, according to Tyler Pipe, having one independent contractor in the state sending you business was enough to create nexus. Well, how about if there's a whole state full of people that are referring people to you and you're paying them all some type of referral fees? Isn't that a lot worse than having one independent contractor here? And the highest court in the state of New York agreed. They said, oh, yeah. This never went to the U.S. Supreme Court, uh, but at its height, about 21 states, followed New York's lead. And, they each had thresholds. The thresholds were between $5,000 and $500,000 of sales from these types of relationships. And it's called click-through or affiliate because they called them affiliate programs. And someone who's an affiliate would have a link to Amazon. And when someone clicked that link, if they made a sale within a certain number of days, then that person would be paid some type of referral fee. A lot of states have sunset these rules since economic nexus came in. Some states have not. And if you're trying to do past exposure, just because it's sunset today doesn't mean the state's going to say it was not in effect during a time period that they're looking at where they want you to pay the taxes. Now, here's another example of how software companies get it wrong. Pay-per-click advertising. Um, uh, I'll mention them by name. Avalara in particular was telling everybody, yeah, if you have Google AdWords, that's click-through nexus, and it wasn't. You have to have specific. Perf I have trouble talking. You need to have specific performance in order to. This is what most of these statutes said. So with pay-per-click, you're paying for the clicks. You're not paying for closed sales. It's the closed sales that differentiate this. But you had Avalara telling all these people, oh yeah, and getting them registered in states where they did not need to be registered. So um, pay-per-click advertising not considered click-through advertising, and in most of the states, this has gone away. You only have to worry about it when you're trying to figure out what your past exposure is, but in some of the states, it's still there. All right, so use tax notice and reporting requirements. This is perhaps the most heinous thing that I've ever seen states do, and the U.S. Supreme Court let them get away with. Um, Use tax notice and reporting. If you didn't have nexus in a state, some states, it started in Colorado, they said, well, we can't make you get registered, but they wanted some of that online sales. So this started back in 2010, and the state of Colorado said, well, you don't have to get registered, but if you choose not to voluntarily register, we're going to make your life miserable. So you're going to have to provide a series of 3 or 4 notices telling that your customers that you didn't get registered to collect the tax, so they have to report the tax to the state directly, and that you're going to turn in a list of all of their transactions to the state at the end of the year. And again, at the end of the year, you're going to remind them they need to be paying the state the use tax directly. We thought this Colorado was absolutely ludicrous. Little did we know that at the time they were one of the more sane states. The states that followed behind them were the ones that were absolutely ludicrous. Colorado, um, they their penalties were not that harsh, where some states had minimum penalties of $20,000 or a lot more. Well, anyway, this spent almost 7 years in the courts, and it got to the U.S. Supreme Court, And the U.S. Supreme Court said this isn't a tax, so therefore it can be decided by the lower courts. Judge Gorsuch, who was on the court at the time, he was not yet a U.S. Supreme Court justice, allowed Colorado to move forward. The Direct Marketing Association immediately appealed to the U.S. Supreme Court, who refused to hear it the second time. So, uh, you turn a blind eye to it, it allowed the states to do it. So states like Washington and Pennsylvania had $20,000 minimum penalties, but they have since done away, since economic nexus came in, they did away with these use tax notice and reporting requirements. Vermont has not, Puerto Rico has not, Oklahoma has not, and Louisiana has not. And of all the states out there, Oklahoma was perhaps the worst. Um, they said that there were three things you needed to do, and it was a minimum of, by the way, their threshold was $10,000, no transactions, but for each violation, it was uh, $20,000 or 20% of the previous year's revenue from the state. So even if you look at the previous year's revenue was $10,000, all right, so $2,000 is a heck of a lot better than $20,000. That seems reasonable so far. But for each transaction, there were three things you needed to do. So all of a sudden, we go from 2,000 to 6,000. And how many transactions did you have to get to $10,000? Was it 1,000? Was it, 500? Was it 200? I mean, we were seeing potential penalties quickly exceed $1 million. I mean, that's absolutely ludicrous. And for the first, this was implemented in 2018. For the first 5 years, it was written that the department could mitigate some of these uh, fines and penalties. And after that, their ability to do so went away. Now, I have not seen Oklahoma try to institute any of these draconian uh, penalties, $1 million or more. I mean, you could have $10,000 in sales and in theory have $1 million in penalties. I don't think that would stand up in court. However, the threat is hanging out there. So our clients generally are going to, uh, even though they don't have the $100,000 of economic nexus, once they're over that $10,000, they're going to look to get registered because it's still on the books. They say that they still have this use tax notice and reporting requirements. All right, so developing trends. These are some that we talked about. Number of states, but not all, are moving away from the transaction threshold. Some states, like Illinois, still have it. Some, but not all states are eliminating affiliate or click-through nexus as they implement their economic nexus. And then some states are eliminating noticing reporting requirements. You got to still look out for Louisiana, Oklahoma, Puerto Rico, to a lesser degree, Vermont. I mean, some people may have only four sales in Puerto Rico for the entire year. If that's the case, we're telling them, hey, just stop selling into Puerto Rico. I mean, the on four sales, in theory, you could have, $25,000 plus in potential penalties. Doesn't make sense to me. Now, if you're selling, $100,000 a year in Puerto Rico, or that makes a heck of a lot more sense. Um, you can justify getting registered for sales tax, even if you're selling $5,000 a year. That can justify a registration for sales tax. Because once you get registered for sales tax, you don't have to worry about these notice and reporting requirements anymore. That's why our clients are getting registered in Oklahoma. So they don't have to worry about the notice and reporting requirements. Same thing in Puerto Rico. But if you only have $300 or $400 of sales in Puerto Rico, does that justify the cost of getting registered and collecting tax? No, at that point, just stop selling into Puerto Rico. All right, Ellie, let's do the next poll question.
Absolutely. We have a quick true or false question here. You must have physical presence to create Nexus. Quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. We will leave this open while Mike carries on and you can keep answering. And if you have any trouble with the poll, just let me know.
Okay. We said we were going to revisit third-party nexus, and I think we need to pay special attention here because this is what trips more people up than anything else when it comes to nexus. Because it just doesn't make common sense to me. I mean, really smart people often don't see this. Because if we're thinking of what activities we do to create a link or connection with the state, or our clients do to create a link or connection with the state, we're often not looking at the activities of third parties. So this is a partial list up here. This helping to establish or maintain a market is really umbrella language at this point. The first two cases we talked about were really about sales, um, but it includes a lot more than that. And rather than go through this all, I'm going to give you what we tell our clients. If someone is going into a state and they are interacting with your customers, or they're interacting with the general public, then that's probably going to be Nexus creating. Whereas, maybe you hire someone to develop software for you on a 1099 basis. They're not interacting with the general public, probably not helping to establish or maintain a market. Or you hire a bookkeeper on a 1099 basis, again, not helping to establish or maintain a market. So it's not all third-party relationships. It's just those that help to establish or maintain a market. But I think that we need to look at all of our third-party relationships to see if they may actually be doing this. And by the way, you don't have to actually call them independent contractors or subcontractors. It could just be a company performing services on your behalf is enough to create this nexus. All right. And traveling, it's not just where your employees or contractors live, but anywhere they're traveling on your behalf. So with contractors, they still have to be helping to establish or maintain a market wherever they're traveling on your behalf. But employees, not so much. It's a much lower threshold there. So a lot of states, Illinois and uh, Arizona, if you're there for greater than 48 hours cumulative throughout the year, that can create nexus. Now, there are certain carve-outs, but uh, if they're there for most reasons, that's going to be nexus creating. That's a pretty low threshold. All right, so inventory creates a physical presence nexus in most states. Now, Amazon inventory no longer creates nexus in some states under certain circumstances, like in Texas. Um, if the all the inventory is being used to fulfill only Amazon sales, it's not being used to fulfill Shopify sales or something like that, then it no longer creates Nexus, but it is creating Nexus if it is used to not only do the Amazon, but the Shopify. Um, in Arizona, if you ship it to Arizona yourself, then it does create Nexus. If Amazon just moves it to Arizona, then it no longer creates Nexus. But a lot of people, say, well, hey, Amazon's paying the taxes. This is their problem. Well, the whole argument why Amazon should have been paying the taxes, and I think it was a good one, is that, Amazon's, it's consignment. I'm sorry, the word was escaping my mind there. It's like a consignment sale. So therefore, we don't have to pay the taxes, and that is a great argument. However, most states say inventory, whether consigned or carried by sales reps or whatever, whatever. I mean, they specifically talk about consigned inventory, so you can't have your cake and eat it too. So inventory, even in an Amazon warehouse in most states, is going to create a nexus for not only sales tax, but in most instances, an income tax also. Related entities. If third parties can create nexus for you, how much easier is it for a related entity? especially if they're performing services for each other or they're not being kept totally separate from each other. They're sharing resources. Sometimes just having the same name and selling similar items and having common ownership is enough to create nexus. Ownership of rental or tangible personal property. If you lease or rent to others, you still have some sort of ownership interest in that. And if it crosses a state line, you now own something in another state. Having inventory in another state is creating a link of connection. You have equipment in another state. So these are all very common nexus creating activities. Where you have employees' locations or where you live and operate your business from. A lot of people tell me, well, Mike, hey, I don't have any of these links or connections you're talking to me about. I'm a remote seller. I mean, I do everything in the cloud. Well, the states don't look at it that way. Where you live or where you operate your business from uh, actually creates some sort of link or connection. All right, so here are 10 common Nexus creating activities for sales and use tax. These are up on our website. Ellie's going to give them out today. When we say common, most states, if not all states, look at these activities the same way. And so these are very common nexus creating activities. And those are in direct contrast to 12 state specific nexus creating activities, where the states look at these activities widely different from each other. So again, this will be up on the web page. All right, so we're going to go over some case studies really quick. Um, one of the ways that states find you, because they know that independent contractors generally receive 1099, so they're looking for people utilizing independent contractors. They go to the IRS and they say, "Hey, give me a list of everyone who's received a 1099 in our state." And then they start looking who issued them. Well, in this instance, it wasn't an independent contractor, it was actually Amazon. If you sell a certain amount with Amazon, they're required to give you a 1099. And this seller came to us. They were actually an early adopter. They lived in Missouri. There were no warehouses in Missouri. He went out and got registered everywhere Amazon had a warehouse. So this is a fairly old case study here, but he came to us and he said, "Hey, I just got contacted by the state of Missouri. I need you to make this argument for me that I don't have any connections with Missouri." And we say, "Well, we don't think that's going to work." Um, and he said, "Well, can you try it?" And he said, "Sure, we'll try it." And the state of Missouri said, "Nice try." No, he himself is the connection with the state of Missouri. He lives here. There's a connection. So we did help him out. Not everything he sold was taxable, so we got the numbers down, but the state had him dead to rights. And this is a way that states find companies. And if independent contractors are one of the biggest risks out there, it's fairly easy for the state to find out if you're utilizing someone and paying them on a 1099 in the state. All right, so let's talk about uh, camera leasing. There was a high-grade camera equipment company. They were selling or leasing all across the country. The state of Massachusetts found them, told them they had nexus due to owning tangible personal property in the state. The company said, "We can't be doing it wrong. Everybody in our industry does it this way." Massachusetts, "Oh, that's great information. Get a list of everyone in the industry. We're going to go after them also." So we got a call from one of their competitors. That's how we found out about this. It said Massachusetts contacted them. He said, "Can you believe one of my competitors turned this in?" And unfortunately, it happens more nowadays than back then. After Wayfair, um, we're seeing more and more of this. Companies, want to get registered. They're afraid their competitors are not getting registered, so they want to know where they can turn them in. But anyway, this we had to let them know. Unfortunately, yeah, this is something that not only do you have problems in Massachusetts, you probably have problems all across the country. So we helped them, beat Massachusetts back a little bit. Not everything they were doing was taxable. States often try to get every last penny they can from you, but we want to make sure they get what they get, and not a penny more. So we help them out there, and then we help them get compliant in the rest of the country. All right, so specialized software company. One of the takeaways from that other one is, how else can you be fined? Well, people can tell on you. That's one of the ways that states find you. This one here, the takeaway in this one is going to be just because it's never been a problem before doesn't mean it's not going to be a problem going forward. We've always done it that way. Famous last words for a lot of companies. And this one here, um, the CPA was a fraternity brother of the owner of the company, and 35 years ago, the owner of the company said, "Hey, what creates Nexus?" And the CPA said, "Well, traveling salespeople, so don't let your people travel and you're going to be okay." And for 25 years, there were no problems until they were contacted by the state of Washington. By the way, they were in Oregon, and Oregon doesn't have a sales tax, so they weren't very familiar with the sales tax. And um, they they told the state of Washington, "Oh, no, you must be wrong. Our salespeople don't travel, so we can't have nexus with your state." And the state of Washington said, "Well, someone's traveling because we audited one of your customers and they're reimbursing you for travel expenses. So we know someone's traveling. And by the way, you're doing installations and implementations, and those are taxable in our state. So we want the last 7 years of back tax plus penalty and interest." And it was well over $500,000. And that's when they called us after the audit was over, because the state told them, "You probably have these problems everywhere." Um, and they called us virtually crying, and they thought they were going to jail. And I had to talk them down off that ledge and say, "You're not going to jail. You didn't collect the tax and not remitted. That's usually what people go to jail for when it comes to sales tax. But you didn't collect it. You just didn't know you were supposed to collect it. Well, maybe we need to be in jail because at least we'll have a roof over our heads and get some, meals out of it. Because when our bank finds out we have all this potential exposure, they were estimating well over $15 million based upon Washington at that point. Um, they're going to pull all our credit lines and we're going to be out of business." And we said, "Well, there's ways around this." And we explained what our plan was to reduce that $15 million. They said, "Would you talk to our bank?" We said, "Sure." The bank wasn't happy, but they were in pretty deep with this company. So they said, "You know what? We're going to loan you the money to get this fixed." And that's a problem with some companies because, even if you have doing some amnesties and voluntary disclosures, which we did for this company here, you still have to pay something. And a lot of companies just don't have the money to do so. They have to tackle this, they needed to do over 40 states. Some companies, limit this to 5 states at a time. It's how do you eat an elephant? Well, one bite at a time. That's the way that they approach this. But the bank said, "We're going to loan you the money." And when all was said and done, we got that $15 million down to $1 million or so. And I've never seen anybody so happy in my entire life to pay $1 million. But you got to remember where they're coming from. They thought they were going to jail, then they thought they were going to be destitute and out of business. And eventually it all worked out for them. So, um, the moral of that story, like I said, just because it's never been a problem before doesn't mean it's not going to be a problem going forward. I could tell you story after story. We did it this way for 25 years. Okay, great. I get a call back 6 months later. "Well, I think you were right. So and so found us. They said we got problems." And how do states find you? Well, we talked about auditing your customers. That's a big way. If you sell on a business to business basis, when one of your customers gets audited, not only are they looking at whether they collected all of the tax they should have collected, um, but and remitted all of that tax, but did they also pay all of the tax they should have on their purchases? They want to make sure that they're paying their consumer use tax, because just because someone doesn't charge you tax doesn't mean that it's tax free. It means you're supposed to self-assess and remit it directly to the state. Um, so the states use that, the auditors use that as a prospecting tool. And the problem is, uh, they create these lists and they have discovery units. Each one of these states has a discovery unit that will follow up on these lists. So, um, auditing your customer, a big way. We talked about information sharing with the IRS. States also share information with each other. Amazon tells them. California routinely will say, "Hey, give us a list of who's got inventory in yours in the state of California." Web surfing, some states, have software that searches for certain terms. Other states do it the old-fashioned way. They have people combing the websites. We talked about leads, your competitors, but it can be former employees. Some states actually pay bounties um, for any of the money, percentage of the money they collect. So not only can a former disgruntled employee get their pound of flesh, they could get paid for doing it. Uh, Sometimes a customer may turn you in accidentally, not on purpose. They may call the state and say, "Hey, my vendor didn't charge me tax. Do I have to pay consumer use tax on this?" And the state says, "Well, who's your vendor?" Next thing you know, you're on a list. I've even seen spouses and partners. I mean, you get a bad breakup, um, and they just get very vindictive and they want you to feel the pain, and they tell the state all the dirty secrets. So, these are just some of the ways that the states can find you. Ellie, let's go to that bowling question.
Yeah, absolutely. We want to know, what about sales tax nexus concerns you the most? Quick reminder, you do have to answer these poll questions in order to receive CPE credit. And if you have any trouble with these poll questions, please reach out and let me know. Mike, I'll leave this open and you can move forward.
Okay. So let's talk about marketplace facilitators real quick. Sites like Amazon, eBay, Etsy, Walmart. These are what we call marketplace facilitators. And marketplace facilitators are responsible for collecting and remitting the tax. Not platforms like Shopify, or at least the way Shopify has traditionally done business. They are moving into marketplace facilitated territory with some of their programs. So we can't make a blanket statement about Shopify anymore. BigCommerce, WooCommerce, not marketplace facilitators. All states plus DC and Puerto Rico now have marketplace uh, facilitator collection requirements. Now, if you're only selling on a marketplace, and we've been recommending this for years, but we still have clients coming to us and saying, "Hey, I want to get deregistered. I'm only selling on a marketplace." Sometimes even if you're selling on multiple marketplaces, but your sales are outside of the marketplaces are minimal, you can still deregister. And deregistration is a process. You can't just stop filing, which a lot of companies do. Um, Sometimes it's harder to deregister than it is to register. But that's another webinar. Uh, there are some exceptions. You generally don't want to get deregistered in your home state. If you are subject to the Washington Business and Occupation Tax, you don't want to get deregistered there because the marketplaces are not paying that on your behalf. And certain states, it's tough to have product delivered there if you're a drop shipper or something like that. Um, if you don't have a state-specific certificate. So those are some reasons why you may not want to get registered, deregistered. Now, if you're going to deregister due to falling below a threshold, here's some things that you got to keep in mind. Some states have what's called trailing nexus. Trailing nexus means you have 12 months worth of nexus after the last time you actually had nexus. So some states allow immediate deregistration. Other states are going to make you wait for the trailing nexus to expire. When you're doing exposure, a lot of states, even though the 200 transaction Threshold may not be effective today. It may be for previous periods, and they followed the old rules when generating exposure. So you got to be careful of that when you're figuring it up. Deregistration warnings, it's a process you just can't stop filing. States are notorious for not doing what they say they're going to do. When you do exactly what they say you need to do to get deregistered, whenever we're doing deregistrations, we always follow up with the states 20 to 30 days later to make sure they actually did what they're supposed to do. So we tell them what we're going to do, we do what we're supposed to do, and then we follow up behind to make sure that they did what they're supposed to do. Very important. Turn off the tax after you deregistered. So many times we go through a deregistration process and someone doesn't turn their taxes off, and then they come back to us and say, "Hey, you helped us deregister, but now we got all this tax. What are we supposed to do with it?" Some states will let you get it remitted. Most states are going to make you get registered again. So it's a problem. Make sure you turn off the tax after deregistration. Last point, income tax, totally separate from sales tax, has its own nexus rules. And deregistering for sales tax has no impact on your income tax requirements. All right, so marketplace collection, not all positive. Nexus still created in most states. You need to collect tax for your other channels. States are still pursuing sellers for back tax plus penalty and interest. The state of California is notorious for this. You could still have filing responsibilities, like in the state of Washington for their business and occupation tax. And this last one is the worst one. States can easily access seller information, and income tax, I think, is going to be the next big battle when it comes to for e-commerce sellers. Here are some of the most aggressive states out there. Uh, FBA sellers, they're going to be the first target. California's already uh, going after them. Pennsylvania already going after them. It's not going to stop with FBA though. We've got the MTC, the new guidance for Public Law 86-272. And states like New York and New Jersey and California have implemented this. Here are the revised unprotected activities. Providing post-sale assistance to customers via electronic chat or email. If you're selling online, you're probably doing that. Um, Inserting cookies into computers or other electronic devices of customers. If you're selling online nowadays, you're probably doing that. Remotely fixing products via the internet. So these new guidelines virtually eviscerate the protections of Public Law 86-272. Public Law 86-272 said if the only thing you were doing was selling tangible personal property, the state could not impose a net income tax on you. So this is what has protected many companies from having to pay income tax. And I think over the next 2 years, we're going to see a lot of states join states like New Jersey and uh, um, New York and California. Hawaii, they don't use the same methodology, but they say that Public Law 86-272 doesn't apply if you have uh, significant nexus. In other words, $100,000 or 200 transactions. So I think that it's going to be an all-out assault at this point. And Ellie, why don't we see if we have any questions?
Yeah, before we do that, I'm gonna launch the last poll question here. Just a quick, easy question. Are you joining us for our next webinar? I'll leave that open. Mike, let me take a look here. I don't think we have any questions right now. Is there anything else that you want to go over?
Yeah, let's talk about what the future holds. And I think it's a dichotomy. I think the sales and use tax future looks bright for marketplace sellers. Past issues are still going to create problems for you in some areas like California. Um, but for those who are selling outside of the marketplace, I think it's going to get ugly if you're not compliant. States are going to be looking for economic nexus out there, but they're going to stumble across all types of nexus. And the states are going to start making examples of companies. And I think that, as I mentioned a couple moments ago, income tax or similar taxes are going to become a much bigger issue as we move forward. So let's talk about some ways to register at this point. You can register prospectively. We talked about that earlier. Registering prospectively means that you use today's date or a date in the near future. Um, and sometimes this is what you need to do because you just uh, created Nexus. So you need to register prospectively. Some companies want to stop the bleeding and they don't want to deal with it the way the states want you to do it, which is take care of that past exposure. They say, I'll deal with it when the state gets to me. So they want to just register prospectively, register going forward. In most states that will work, in states that we mentioned earlier, like Illinois and Wisconsin and Arizona and Arkansas, you can't do that. They are going to come after you. It's not a matter of if they will, it's a matter of when they will. Registering historically is using the actual date that your nexus began. And once you do that, the state's going to say, thank you very much. Now, please give us all the back tax plus penalty and interest. That is a viable route. You can always ask for penalty waiver. Um, if your exposure is material, you probably want to register through a voluntary disclosure agreement. And a voluntary disclosure agreement, the state's going to reward you for stepping forward voluntarily. And the reward is like in California, instead of them, if they fund you, they'll go back 8 years. If you step forward voluntarily, 36 months. So right away, you're saving 5 years worth of back tax, penalty, and interest. And then in that 36-month period, they're going to waive all of the penalties. So you'll only have to pay 36 months of back tax plus penalties. So a VDA can be a great tool, but just like all tools, it's not a one size fits all tool. Now again, I'm going to throw a software company underneath the bus. Avalara at one point was telling everybody, if you owe more than $500 to a state, you need to do a voluntary disclosure agreement. Oh, by the way, we charge $3,500 per VDA. So people were coming to us with $120,000, VDA invoices, and they hadn't paid a penalty of back tax. And some of these people only owed $60,000 in back tax. Why in the world would you pay anybody $3,500 to remit $500 worth of tax for you? I mean, I think that's absolutely ludicrous. I don't know how these software companies or the salespeople for them can actually sleep at night. We always tell people you have to be saving at least as much money um, by doing a VDA as the cost of the VDA. Otherwise, you might as well register historically or take care of that past exposure some other way. So it's a great tool, but it's not a one size fits all tool. If you need help doing that, we have an exposure review with a VDA cost benefit analysis attached to it, where we'll make recommendations on what makes sense on how to move forward in each states, looking at not only your exposure and the potential exposure, the potential liabilities of each of these states, but also how aggressive the states are. And, some of the things, some of the options you have in some states that you just don't have in other states. All right. So, and then you can register and do a managed audit. As we mentioned, some of the loss mitigation programs are off the table once the states find you. California is a big one of those states. But they have what's called a managed audit. And a managed audit is when you ask for a full-blown audit, only someone like us administers the audit rather than the state. And so that we do it under the supervision of the state, and as a reward for not allowing the or making the state use their own people and resources, they're usually going to waive the penalty and 50% of the interest. Now, they don't cut back on any of those years, but if you've got an 8-year look back period, the interest in that can be quite substantial. So it's a great tool, that managed audit, for people who cannot do the VDA. VDA is always going to be your best tool if you can use it when there is a lot of exposure. And Ellie, at that point, I think we can wrap it up if we don't have any questions.
Yeah, thank you so much everyone for joining us. And please, if you have follow-up questions, don't hesitate to reach out and don't forget to fill out the survey if you'd like CPE credit.
Thank you, everyone. Take care.